The downfall of a real estate empire has triggered a tsunami in the Chinese construction industry. Evergrande, once a company on the Fortune Global 500 list and a leading real estate developer in China, finally imploded after a debt crisis. The collapse of the Chinese real estate sector is now having a domino effect on both the upstream and downstream of the supply chain. According to Chinese media reports, more than 2,200 construction-related companies have filed for bankruptcy from April of this year until now. From January to August 2023, over 1,300 construction-related companies faced bankruptcy reorganization. Taking the prosperous construction industry in Nantong City, Jiangsu Province as an example, in 2017 there were over 2,000 construction companies in Nantong, including 21 with top qualifications and 215 with first-tier qualifications. The industry employed over 1.6 million people. In 2001, the total output value of Nantong's construction industry was nearly equivalent to the city's GDP, surpassing 1 billion yuan. However, today, both small and large construction companies are grappling with broken financial chains, and in just 2 years, many of these businesses have faced near-total collapse. The massive collapse in the Chinese real estate market has led to a chain reaction in the construction industry, causing numerous cement factories to shut down or even go out of business. According to incomplete statistics from cementrend.com, more than 110 cement, concrete, and cement product companies have gone bankrupt this year. Market share battles and cement price wars are occurring one after the other. With decreasing demand in the construction market and severe overcapacity in cement production, cement factories are shutting down on a large scale, and many are facing closure. According to a report by the China Cement Association, China's cement demand remained weak in 2022, with an annual cement production of 2.13 billion tons, a 10.5% decrease from the previous year, and the lowest in a decade since 2012. Cement prices have also continued to decline. In July 2023, the wholesale price of cement in bulk commodities was 331 yuan per ton, approximately $47.30 per ton, a 13.35% decrease compared to the previous year. Since September 2023, a nationwide price drop in cement has been observed. In cement-rich provinces like Shandong, the lowest market prices have reached 130 to 140 yuan per ton, approximately $19 to $20 per ton. Some enterprises in Guangdong are selling cement for 180 to 190 yuan per ton, approximately $26 to $27 per ton, marking the lowest prices in nearly a decade within the province. Even in Fujian, where cement oversupply was almost unheard of in the past, cement prices have dropped to their lowest levels since 2017. For example, in Guangdong, where a price war erupted, the province is the second largest cement producer in China, with at least 6 large enterprises, including Conch Cement, China Resources Cement, and Taiwan Cement, which have significant financial strength. Guangdong's cement clinker production capacity reached 106 million tons. In the past, the construction industry's cement demand in Guangdong exceeded 50 million tons annually, accounting for over 40% of the province's total cement demand. Now a significant contraction in demand in the real estate and infrastructure markets. Even implementing staggered production suspension measures for 60 days cannot resolve the oversupply issue. The cement market in Guangdong is unavoidably facing a rebellion of the lords, affecting other surrounding provinces and cities like Guangxi. In neighboring Guangxi, full-year demand for 2023 is expected to be less than 70 million tons. In recent years, Guangxi has invested in large-scale production lines with capacities of 5,000 tons and above, totaling 75 production lines with an actual cement production capacity of over 170 million tons, resulting in severe overcapacity. Amid declining market demand and severe cement overcapacity, staggered production has become a lifesaver for regional enterprises. As early as May of this year, nearly 10 provinces and cities, including Shandong, Shanxi, and Jiangxi, had already implemented cement plant production restrictions. Because cement production consumes a significant amount of coal, China's cold northern regions initiated off-peak production restrictions during the autumn and winter heating seasons, which later spread nationwide. According to mainland media reports, cement producers' off-peak production times have extended from the autumn and winter heating season to various periods throughout the year, and some regions have even halted production monthly. In some areas, off-peak production will be in effect for more than 180 days in 2023, and in certain regions, it will exceed 200 days. Even most ultra-low-emission enterprises in various regions have had their off-peak exemptions revoked. Recently, media reporters attempted to call some cement companies in Nanning, Guangxi, but received no response. A construction engineer in Guangdong said that many places have halted cement and concrete concrete production, with almost all construction companies in dire straits and construction companies in Jiangsu going bankrupt, the entire real estate market is experiencing a significant downturn. According to mainland Chinese reports, a representative of a company in Guizhou stated that due to irregular production halts when their warehouses were full, most workers in various positions chose to resign. Those who remained were doing the work of 10 people, yet their wages were only slightly more than half of what it used to be. Meanwhile, faced with continually declining prices, some companies with relatively high costs adopted an indefinite leave model to cope with the economic downturn. Numerous companies in the same industry have also had to resort to cost-cutting measures, including layoffs and salary reductions, with some employees seeing their salaries reduced by up to 60%. Workers are now earning around 2,000 yuan per month, approximately $273, which is insufficient to meet the rising cost of living. Many have been forced to change careers or seek employment with relatively stable companies to increase their income, resulting in a severe slump in the entire industry. Previously, China had implemented extreme policies like the Great Leap Forward in the steel industry, where every household had to surrender their pots and pans to be melted down for steel production. This approach was essentially a futile effort that caused harm to both people and the economy. Today, the Chinese government seems to be adopting a similar strategy, with many cement factories being forced into long-term shutdowns, which is nearly equivalent to bankruptcy. Apart from cement, building steel materials account for 60% of the construction industry in various sectors, including infrastructure, residential, commercial, and industrial construction. Statistics show that from the aftermath of the pandemic until August 2022, 892 steel companies incurred significant losses. China's leading steel company, Baowu Steel Group, reported an 8.58% drop in revenue and over 50% year-on-year loss in net profit, attributable to shareholders, in the first 3 months of 2023. Operating cash flow also plummeted by 159%. By June 2023, the price of rebar had dropped from 4,600 yuan per ton, approximately $657, to 3,600 yuan per ton, approximately $514. Many provinces and cities witnessed a wave of steel mill bankruptcies. The 23-year-old Delong Steel Group halted production and dismantled its blast furnace at the end of June, sparking international attention to the wave of closures in Chinese steel factories. In other words, the collapse of the Chinese real estate sector has led to the suspension of construction and the bankruptcy of companies along the supply chain. These dual collapses are mutually reinforcing, indicating that China's economy is deteriorating at an unimaginable pace. Furthermore, following Evergrande as the current largest real estate developer in China, Country Garden may trigger a second financial crisis. According to Country Garden's financial report released on August 30th, the company incurred a net loss of up to 48.9 billion yuan, approximately $6.7 billion in the first half of this year. If the financial situation continues to deteriorate, there is a risk of debt default. Country Garden's total debt is $187 billion, making it one of the most heavily indebted construction companies globally, with a project count 4 times that of Evergrande Group. Country Garden stated that, despite its best efforts to arrange domestic and overseas financing for principal and interest repayment, the company's available funds continue to decrease due to decreasing sales and worsening refinancing options this year. According to the reports, one of the company's US dollar bonds has reached the end of its grace period but remains unpaid. The bond's maturity date is September 17, 2025, with an issuance date of September 17, 2019, and an interest rate of 6.15%. According to data from Duration Finance, the bond had an issuance size of $500 million with an outstanding balance of $470 million. Based on the payment date of September 17th, it has reached a final deadline for the grace period. On October 18th, Country Garden stated that the company expects that it will be unable to fulfill all of its obligations to repay overseas debt as scheduled. This would mark the first public default by the Chinese developer. Chris Bedore, Deputy China Research Director at Gavical Dragonomics based in Shanghai, commented, "I think this is a reminder of how bad things are for China's property developers, especially the private ones. It's really concerning and really sad." According to incomplete data from the paper, a Chinese digital newspaper, Country Garden has a total of 7 overseas bonds maturing in 2023 and 2024, with outstanding balances including 3 billion Hong Kong dollars, nearly 3,000 million Thai baht, and 1.55 billion US dollars. Country Garden emphasized that the company has not yet paid the principal of 470 million Hong Kong dollars for a certain debt under this particular issue and anticipates it will be unable to fulfill all its obligations to repay overseas debt as scheduled or within the grace period. This includes, but is not limited to, US dollar bonds issued by the company. Country Garden stressed that it places a high priority on managing overseas debt and protecting the interests of all bondholders, requesting that bondholders allow time to evaluate the current challenges and work with advisors to develop practical and viable solutions. The announcement further stated that, although Country Garden has made every effort to raise cash flow through various means, including asset disposals, it remains difficult to rapidly replenish sufficient cash flow to improve liquidity in the current market situation. Currently, Country Garden has obtained the necessary approval from relevant bondholders for extension proposals for 9 domestic corporate bonds, with a total principal amount of approximately 14.7 billion yuan. A bondholder mentioned that as of 9 a.m. on October 18th, Hong Kong time, they had not yet received funds from Country Garden. Country Garden did not immediately respond to requests for comments from various media outlets. The company's sales volume has also significantly declined. Country Garden announced that its contract sales amounted to approximately 6.17 billion yuan in September, with a contracted sales area of around 830,000 square meters during the period. From January to September this year, Country Garden achieved an equity sales amount of about 155 billion yuan, representing a year-on-year decrease of 43.9%. Country Garden has $9.9 billion in outstanding notes and is preparing to face default and restructuring. It is reported that this will be one of the largest restructurings in China's history, and the restructuring process may take several months. The current situation of Country Garden, like that of Evergrande, is not an isolated incident, but reflects the true state of the entire Chinese real estate market. Economic data shows that real estate investment in China has declined by 9.1% in the first 9 months of this year. Sales by floor area have decreased by 7.5%. The Hong Kong Hang Seng Mainland Properties Index has fallen by 40% year to date. Since the third quarter, all of the rescue measures proposed by the Chinese government regarding the real estate market have proven futile in the face of September data just released by the National Bureau of Statistics. Looking at the first quarter of this year, the sales of commercial residential properties amounted to 299 million square meters. In the second quarter, it was 295 million square meters, and in the third quarter, it was 252 million square meters. Note that the general rule in the real estate market is that the sales volume in the second half of the year should be greater than that in the first half, with the sales volume in the second half of the year accounting for about 60% of the annual total. However, in the third quarter of this year, this rule did not apply at all. Some media predict that, based on data from the first 3 quarters, the sales volume in the fourth quarter will not be high either. This year's total sales volume of commercial residential properties is estimated to be approximately 1.04 billion square meters, returning to 2010 levels. China's real estate sector is facing massive sell-offs, and stock prices have plummeted to their lowest levels since 2009. Bloomberg reported that the Bloomberg Intelligence China Developer Index fell 1.2% on October 18, reaching its lowest point in 14 years. Despite a series of stimulus measures by the Chinese government aimed at revitalizing the real estate industry, which accounts for a quarter of China's economic output, the troubled Chinese real estate market has shown almost no signs of recovery in the short term. On October 20th, Reuters reported that Beijing resident Daniel Song's parents gave him 3 million yuan, approximately $410,000 at the beginning of the year to buy a house, but he recently abandoned the idea due to concerns about whether his income could guarantee the repayment. The 28-year-old computer programmer said, "In today's economic situation, I'm not sure about my career prospects. These support measures have yet to see any significant impact on cautious buyers." On October 19th, official CCP data showed that new home prices in China fell for the third consecutive month in September, dropping 0.2% compared to the traditional peak buying period in August. The prices of newly built homes in Shenzhen and Guangzhou continued to decline in September. Among the 70 cities that released housing price data, 54 cities saw price declines last month, up from 52 cities in August. Prices of newly built homes in third-tier cities fell 0.3% month-on-month, compared to a 0.4% decline in August. Late October data also shows that real estate sales and investments have continued to decline by double digits, down 19.8% and 18.7% respectively since the third quarter, indicating that the Chinese economy has yet to escape its difficulties. Andy Lee, CEO of Centaline China Property Consultants Limited, a real estate brokerage, stated that while most of the loosened policies have lowered purchasing costs, they have had minimal effect on creating new demand. Some developers have stated that they expected sales in October to remain weak because the few visits by potential buyers to websites rarely translate into actual purchases. According to media reports, the head of a development company with projects in major cities stated that sales during the Golden Week holiday period were down 20% compared to the same period last year, but better than September. He stated that sales had fallen again after the holiday ended. At the beginning of the year, the industry expected the first half to be bad and the second half to be better, but the reality is that the first half was bad and the second half is worse. People are starting to lose trust in China's real estate market. Doris Dong, a 30-year-old housewife living in Beijing, said, "In a sluggish real estate market and a sluggish economy, my desire to buy a new house is not as strong, and I want to keep the money in my pockets." S&P Global Ratings lowered its forecast for this year's real estate sales in China this week, expecting a decline of 10% to 15% from 2022, compared to its previous forecast of a single-digit percentage decline. It also predicts a further 5% decline in sales in 2024. Furthermore, the market contraction has accelerated the pace of layoffs by real estate companies. It is reported that Country Garden disbanded 30 subsidiary design institutes, resulting in the layoff of 2,000 employees. According to information from the Cement People website, nearly 30,000 employees have been laid off by 22 real estate companies in China since the beginning of this year, in addition to the 160,000 layoffs by the top 50 real estate companies last year, totaling nearly 200,000 job losses. The cascading collapse of the real estate sector has a rapid impact on related industries such as construction, cement, and steel, and the entire supply chain is collapsing like a set of dominoes. Therefore, the collapse of the Chinese real estate market is not just a collapse of the real estate sector, but also marks the beginning of a countdown for the entire Chinese economy.